It's time for another case study. This time around, we've got an NPL SR that was paid. In other words, a non-performing loan in senior position that was paid by the borrower with a discounted settlement. So digging into the details here, we can see originally this was secured by a single family residential property, but because the taxes were sold and the tax deed was transferred back to the city where the taxes were unpaid, it leaves no equity and in fact is not in senior lien position, but is unsecured. This debt can no longer be pursued through foreclosure and there is no collateral protecting our investment any longer. So let's dig in a little further and see it is a bunch of zeros. The collateral value doesn't matter, the taxes are irrelevant, and there is no equity protecting our investment. And if we look a little further, we can see the balance that the borrower owes is $6,891. And because there is no equity, the equity coverage and combined loan to value, or CLTV, are also irrelevant. So what do we actually pay for this investment? Well, because we knew it was unsecured going into it, it was originated in first position, but because the tax foreclosure happened 6 years prior to our investment, we knew we could price this as an unsecured debt. In other words, less than 1% of the principal balance. Generally, unsecured debt in the secondary market trades for around 50 basis points to 1%, 50 basis points being 1/2 of 1%, but can sometimes trade for a bit more. In this case though, we bought it for about $69. Yes, you heard that right, less than $100 for this investment. So let's start with the borrower story here. And it's an interesting one because this borrower actually reached out to us proactively. They knew that they owed this money. They also knew that they no longer own the property, obviously. They knew that they stopped paying the taxes 6 years ago, and now the deed to their property was no longer in their hands, but they wanted to make good on their promise to pay. The promissory note that they originally borrowed, they were very interested in just getting that off their chest, getting it off their back, and pay it off. So let's talk about what the potential internal rate of return on this deal was. And then we'll go into the actual internal rate of return by calculating this, including some of the fixed costs and other fees that we incurred. Now, our internal rate of return can be calculated with this pretty easy formula. Total amount collected minus your cost basis, what you paid for the loan, divided by your cost basis, which is essentially your return on investment, and then annualized by dividing that by the months to exit divided by 12. So essentially annualizing the amount of time it took to achieve that exit. So plugging in the actual numbers for this particular deal, we earned $4,420. So the borrower almost paid 100% of what they owed. They owed $68,000. They paid $4,420. And with our $69 investment divided by $69, that's a 6,006% ROI if we did it in 1 year. In other words, the denominator of this would have been 1. But because it only took 3 months or a quarter of 1 year, we can run that calculation and actually see it was 25,223% internal rate of return. But this doesn't really incorporate the servicing costs on the loan and the due diligence expenses. So just to be super conservative here, let's take the $25 per month servicing fee, so $75, and let's say we spent $500 in our analysis and due diligence of this loan, which is way more than we spent. In fact, with an unsecured debt like this, you don't even need to run a BPO, broker's price opinion, to get the actual fair market value of the property, since there is no property to secure your investment again. So in this case, $500 of due diligence is way over what we actually paid for it. But just to run those numbers, let's look at it. $4,420 is what we received from the borrower for the settlement, minus $644. That's $75 of servicing fees over 3 months, $500 of due diligence, and then the $69 cost basis with the contract price of the loan from the seller, leaves us with a 586% return on our investment if it was in 1 year. And when you divide that by the quarter of a year that it took, it is still a 2,345% internal rate of return for this deal. So pretty crazy. And a couple takeaways here, because I think it's very interesting to see unsecured loan pay off in this manner. The first takeaway that I have for you is kind of the logistics about getting an unsecured debt settled. So when we generally have a regular mortgage note that is paid off, we record a lien release in the public records. It's also called a satisfaction. And that satisfaction removes the lien from the property so that a title company, when they look at this property in the future, when it's transacted, they can see there are no encumbrances. There's no liens secured by that property, or at least our lien has been wiped out. It's no longer secured. But because this loan was already unsecured and it was already in the hands of the county or the city who took back the property through the tax foreclosure process, there was no lien on the property anymore. So the only thing we need to do would be to stamp the original promissory note paid in full. And then we'll sign the manager's name from US Mortgage Resolution, which was the lender on this account, and then send the borrower a copy or even the original version of that note showing that it has been paid in full and is no longer an obligation for them. So another takeaway here is don't count out your unsecured or underwater loans. You'd be surprised how many borrowers are really willing and able to take these debts and pay them off, sometimes at a discount like with this deal, but often paying it in full because they know that they owe this obligation. They borrowed the money at one point. And I've heard so many times, I don't want you to think I'm a deadbeat. A lot of borrowers will say that because they know that they're in a tough spot. The lien is still, or in this case, the debt is still something that's hanging over them in some way or another. And they want to get that paid off because they are a person of their word and they have integrity in that sense. So you'd be surprised in those situations when borrowers are motivated to stay true to their intentions. And at the end of the day, I think the most important takeaway here is to expand your preferences. As a note investor, you don't want to only look at the cream of the crop assets where you're paying 75 cents on the dollar. You can also mix in some lower quality quote unquote assets like unsecured debt for less than 1% of the principal balance, or perhaps non-performing senior mortgages that you're buying a junior position behind a senior that's delinquent, or maybe you're buying a senior lien where the taxes are unpaid. Those types of asset classes are much more affordable than the high quality seconds behind current senior liens with full equity, or the seniors where the taxes have never went delinquent. Those types of investments, you're going to spend a lot more, whereas you can diversify by buying these outside of your general preferences assets. And sometimes you can hit home runs like with this particular deal. That's it for this case study. Stay tuned for the next video next Wednesday, and we'll have another case study as always next month, and we'll have our Be the Bank episode on the last Wednesday of the month. I'll see you then.